We're going to talk quickly about taxes. And taxes, we use something called Roth conversion strategies with our clients. And basically, the idea behind it is if you've saved all of your money for retirement in an IRA or a 401k or a 403b or any of these pre tax accounts where the money is going in pre tax before you pay taxes on it, and it is growing in that account. And at some point, you'll start pulling money out. And when you do, it is taxed as income. Okay. Which is the way IRAs and 401ks work. Then what the strategy is based on is the fact that we believe here at ClearPath that taxes probably aren't going down in the future. A lot of people go into retirement believing that when they retire, their tax bracket is going to go down dramatically. That is absolutely not the case. When you retire, what you have to understand is your money, your income is no longer derived from W 2 income, where the taxes are being deducted before you get it. And now at the end of the year, you've already paid all these taxes into the system. You get a W-2 showing that the taxes that have been paid, and then more than likely you probably get some money back. That's the kind of environment most people are used to. In retirement, there is no paycheck. The money, if you've saved all of your money for retirement in pre-tax accounts like an IRA and a 401k, then the money, every dollar you take out of that account is taxable at whatever income bracket you're in. So it changes the picture dramatically. And now those taxes can add up quickly. And if you're not having tax money taken out of each one of those withdrawals that you take and sent to the IRS so that you get a 1099 at the end of the year, which a lot of people fail to do, then they're not setting aside, 22% of every one of those withdrawals into an account to pay taxes at the end of the year. Then what you have to understand is, all of your income is coming from pre-tax accounts. Your tax bracket's not going down. That is not reality. So when you think about it that way, what we have seen is it makes sense a lot of times in the golden window. And that's what we call the time period between when you retire and when you have to start taking required minimum distributions, meaning you have to start taking money out of those pre-tax accounts and paying the taxes on it. And that typically for most people is around age 73 today for people who are approaching retirement. And so let's say you retire at 65 and you're going to have to start taking that money at 73. What you want to do is you want to try and get as much money out of those pre-tax accounts. Go ahead and get it into a Roth account where that money can grow tax-free and you don't have to take required minimum distributions off of it. You never have to take and pay taxes on that money again. And that's called a Roth conversion strategy. So if you can just take you take what you need to take to live and to have your income in retirement. But if you see that there's room left in your tax bracket at the end of the year, and you can take 20, 30, 40,000 each year in addition to what you need to live on, and go ahead and pull it out, convert it into a Roth, and go ahead and pay the taxes on it now, then it's going to benefit you dramatically in the future because now that money starts to be invested into the Roth, and all of the returns that you get in that Roth, all the growth you get is tax-free. If you leave it in the IRA, it just keeps growing, but it's still all taxable. So all the growth is taxable. If you put it in the Roth, all the growth is tax-free. So that is the major difference there. And Roth conversion strategy is very important to understand. If you are in a situation where you're a married couple and you're looking at this, that Roth conversion strategy that you guys do, if you lost your husband suddenly, having more money in that Roth account than in the taxable IRA accounts is going to so much help you as you move forward, because your tax bracket is going to get cut in half, just like we said. And if you're have Roth money to use, and instead of having to solely depend on IRA money and take more out of the IRAs, then it's going to improve your tax picture so much, and it's going to put you in so much of a better place. So I think it's important that women understand.
It is. And that's why it's so critical to, we always say to execute those Roth conversions in the married filing brackets if you can. Because again, under that same understanding that once one spouse passes, we're going to effectively cut the tax bracket in half. But you're still going to need a similar amount of income when you're pulling from pre-tax accounts. Now you have half the room to do Roth conversions, or you're just going to pay almost 2 times more in taxes to do the Roth conversion. So it's very important if you're doing, this is a form of, planning. This is a form of estate planning, really. If you're looking at retirement and you're looking later down the road and you're like, okay, eventually one of us is going to go, let's start converting that Roth money now and do it at a way cheaper rate.
Yeah. Yeah. And especially if you are already 65.
Yeah.
Because if you're 65 and you're under certain income thresholds, for a married couple, starts around 150 and phases out completely at 250,000 a year. The One Big Beautiful Bill Act, gave you an extra $12,000 standard deduction in addition to all of your other standard deductions. And that gives you even more room to execute this. But understand that that only lasts till 2028 as it stands now. So you have kind of this golden window of the next couple of years to really try and convert those, that money as much as you possibly can. And if you're struggling with this, if you're not sure about this and you think that, you want to take a look at it, see if it really makes sense for you, give us, just come to clearpathretirement.com. Let us know. We'd love to have a conversation with you about it. We'd love to see if, this is right for you. And we'll certainly tell you and help you get clarity on this. Okay. All right. So we've talked about Roth conversions and filling tax brackets. So, here's some common mistakes that we see with Roth conversions. You don't want to convert too much too fast. You don't want to have, all the money that you convert is considered income in the year you do the conversion. So you want to be conscious of, some different things that can come back to bite you if you convert too much too fast. You could push yourself into paying a higher Medicare Part B premium, because Medicare Part B, the premium you pay is based on income. And so be conscious of that. If you do convert too much, you could lose that extra, $12,000 standard deduction, for married couples, or 6,000 for singles, which is, nice to have. And if you can help it, you don't want to lose that. You also want to be conscious of the income thresholds when it comes to taxes on your Social Security. It's important to understand that when you execute these. So there are some moving parts that you need to be aware of. The other thing that I would recommend highly is if you are in a position to pay the taxes from on the IRA, the money that you convert from the IRA to the Roth, if you're in a position to pay the taxes on that from a different account other than the IRA, so maybe you have a brokerage account, or you have some, you have significant emergency fund in the bank, where you have some good cash, that would be ideal to pay it actually from another account and not from the IRA itself. Because If you do that, then all the money from the IRA gets over into the Roth and has a chance to grow tax free, and that's going to benefit you even more. Also, be aware of state taxes when you do this. Don't just be thinking about federal taxes. State taxes come into play as well. So, don't forget that. And don't wait until R&D start to do this. Don't wait until you get to require minimum distribution age and start this. What a lot of people don't understand is I think there's some confusion around, well, can't I just convert my RMDs? And that's not the way it works. You have to take your required minimum distribution, pay the taxes on it, and then do any conversions that you want to do. So I want to make sure we're clear on that. So, again, just to recap today's show and what we've talked about here, women face a very, very, unique situation when it comes to retirement planning. It's definitely that there's definitely some things that we've pointed out here today that women have to think about and be aware of that, maybe their male counterparts don't. And, when you're going to be planning for a longer retirement, higher healthcare cost, you've got things like inflation and things to worry about more because you're going to live longer. All of those things are very important for you to understand. And, I have had the privilege of working with, I can't even count the number of widows and, recently divorced women that are going into retirement. And we are keenly aware of the challenges that they face. And we have real world experience in dealing with these matters. So if you feel like this is you and you want real guidance and you feel like you need some real help, come see us at clearpathretirement.com. Let us know. We'd love to hear from you. We'd love to help you and work with you. And we appreciate you tuning in today. For all of you guys, have a happy retirement. Come back and see us next week.